Warren Buffett once made an intriguing statement in the 1999 Business Week interview. He said that if he were to manage only $1 million, he could guarantee a 50% return per year. Let's take a closer look at his full quote to understand the context. Buffett emphasized that if he had a small amount of money to manage, he would be fully invested. He argued that those who claim that the size of investments doesn't impact performance are misleading. Buffett pointed out that his highest rates of return were achieved in the 1950s when he was investing small amounts, which he referred to as peanuts. He believed that having a smaller sum of money to manage provided a significant advantage. It's important to note that Warren Buffett currently manages Berkshire Hathaway, a massive investment firm valued at over $500 billion. Handling such a large amount of capital requires a different approach. However, Buffett's statement about a 50% return on $1 million suggests that with a smaller amount, he could employ different strategies and achieve exceptional results. In this video, the focus is on exploring the strategies Buffett might employ to achieve such a high return on a smaller sum. While specific details are not provided, the idea is that managing a smaller portfolio allows for more flexibility and potentially higher returns. Buffett's expertise in investment strategies have been honed over decades of experience, and his track record speaks for itself. It's important to understand that Buffett's statement about guaranteeing a 50% return is made in the context of managing a small amount of money. It serves as a reminder that investment performance can be impacted by factors such as portfolio size and flexibility. It's a fascinating perspective from one of the most successful investors of our time. Ladies and gentlemen, gather around and prepare to embark on an unforgettable journey into the exhilarating world of stocks and financial wizardry. Welcome to Stock Marketpedia, where the stock market meets showtime. Let's kickstart this electrifying adventure together and redefine what it means to be the stock market superstar. So without further ado, hit that play button, fasten your seatbelts, and let the financial extravaganza begin. Get ready for a wild ride because Stock Marketpedia is here to rock your world. Investment strategy number 1: investing in small stocks. Warren Buffett, managing billions of dollars, focuses on larger stocks since investing just $1 million in smaller companies wouldn't significantly impact his portfolio. While making $500,000 on such an investment may seem substantial, it pales in comparison to the billions he manages. However, if Buffett were to manage only $1 million, investing in smaller companies could make a substantial difference to his overall portfolio. Even a $500,000 return would provide a 50% return on that smaller sum, making it worthwhile. When asked about achieving high returns, Buffett mentioned looking for opportunities in tiny areas within one's area of competence. He emphasized the importance of understanding the businesses and seeking out small securities where little arbitrage situations or market anomalies may exist. Buffett suggested starting by choosing an industry of interest, such as artificial intelligence, semiconductors, gaming, or blockchain. Becoming an expert in that industry allows for a deeper understanding of the smaller stocks within it. By carefully evaluating these stocks, one may uncover hidden gems and unique opportunities. In simpler terms, Buffett advises starting by focusing on an industry you're passionate about and gaining expertise in it. Then, seek out smaller stocks within that industry that you can understand well. By conducting thorough research, you may discover undervalued stocks or market inefficiencies that present attractive investment opportunities. This approach requires diligence, knowledge, and a keen eye for spotting potential winners. Buffett's strategy highlights the potential for higher returns when managing a smaller portfolio by leveraging expertise and uncovering opportunities in overlooked areas. While his investment approach is tailored to his unique circumstances, it offers valuable insights for individual investors looking to maximize returns with smaller sums of money. To find profitable investment opportunities, choose an industry you understand and have a passion for. Explore the smaller stocks within that industry to discover potential deals and lucrative investments. It's also important to be aware of or familiarize yourself with Strategy 2, which can provide valuable guidance for making informed investment decisions. By following these steps, you can increase your chances of success in the stock market. Investment strategy number 2: applying Strategy 1 principles. Warren Buffett has a strong preference for investing in USA stocks, and there are good reasons for it. The United States has a reputation for trustworthiness and a business-oriented environment that has made Buffett wealthy. When analyzing small businesses, it's crucial to trust the information and figures they provide. In the USA, you can generally rely on the accuracy of these figures because the stock market is heavily regulated by entities like the Securities and Exchange Commission. They ensure that the companies disclose correct information. However, when it comes to investing in small companies in countries like China or certain third-world countries, it becomes challenging to trust the reported figures. Many Americans and Westerners residing in China or other similar countries can attest to the differences in business practices and regulations compared to the United States. The risks associated with investing in those countries are higher due to the lack of transparency and reliability in financial information. On the other hand, countries such as Australia, England, and Canada are well regulated and have trustworthy business practices. Analyzing smaller stocks in these countries is generally considered more feasible. However, according to Buffett, if you want a reliable and secure investment, the United States is the ideal place to focus on. Investment strategy number 3: purchasing undervalued stocks. One important strategy in investing is to only buy stocks when their price is significantly lower than their true worth, known as their intrinsic value. This is especially applicable to small cap stocks, which often receive less analysis and attention. Unlike popular stocks like Netflix, Amazon, or Microsoft that are extensively covered by analysts, smaller companies offer greater opportunities because they are underanalyzed. To identify undervalued stocks, it's crucial to learn how to calculate their intrinsic value accurately. Let's imagine a graph where the green line represents the intrinsic value of a stock, while the black line represents its price. Due to emotional investing, stock prices tend to be volatile, fluctuating above or below their actual value. The goal is to buy stocks when they are undervalued, meaning their price is well below their intrinsic value. By paying less for a stock, you increase the potential for higher returns. For instance, let's consider a stock that earns $1 per year. If you buy it for $10, you would receive a 10% return on your investment. However, if you find the same stock priced at $2, your return would be a remarkable 50%. This simple math demonstrates the advantage of purchasing undervalued stocks. Remember, the key is to focus on finding undervalued stocks by analyzing their intrinsic value. Small cap stocks often provide excellent opportunities due to their underanalyzed nature. By purchasing stocks below their intrinsic value, you increase your potential for higher returns in the long run. Investment strategy number 4: going against the crowd. I have some really interesting points to share in this video, so please stick around and don't get distracted by other YouTube content. One thing I've noticed time and time again is that investors are heavily influenced by their emotions. Let's take Tesla stock as an example. One moment, investors are ecstatic and think they're on the path to riches, but as soon as earnings dip for a quarter, panic sets in and they all start selling in a frenzy. However, if you can take a step back and focus on the facts, you can actually make a lot of money. The best opportunities for making money often arise when everyone else is fearful and running for the hills. Take Facebook stock, for instance. In the middle of 2018, it experienced a significant crash due to concerns about privacy issues and scandals like Cambridge Analytica. During this time, when everyone was panicking and the stock price plummeted, it was actually the best time to buy. That's exactly what I did. I purchased a substantial amount of Facebook stock for my portfolio because the underlying numbers and fundamentals were strong. By looking at the facts, I saw that Facebook's earnings were still solid, and the company was expanding its business. That's why I took advantage of the cheaper stock price. Those of us who bought when the stock was cheap, including myself, have made significant profits with Facebook because we were willing to be greedy when others were fearful. This approach is crucial for achieving great investment returns. Now, let's talk about the possibility of a stock market crash in the near or medium-term future. If you can maintain a stable mindset and buy stocks when they are crashing, you can actually make good money, just like the investors who bought in 2009 during the last major market crash. The key is to control your emotions, remain level-headed, and make rational decisions based on facts rather than succumbing to fear or hype. Remember, it's often when others are fearful that the best investment opportunities arise. So keep a steady mindset, analyze the fundamentals, and don't be afraid to buy when others are selling. By doing so, you can increase your chances of making solid profits and achieving success in the stock market. At the end of the day, those who are actively engaged in investing, analyzing numerous stocks, and diving deep into research tend to perform better. A renowned investor, Peter Lynch, emphasized this by saying that if you examine 10 companies, you may find one interesting. With 20 companies, you may find 2. And with 100 companies, you may discover 10. In investing, the person who explores the most opportunities is most likely to succeed. Warren Buffett echoes a similar sentiment. He describes how he diligently studied manuals, poring over thousands of pages in Moody's industrial, transportation, banking, and finance manuals. Buffett believes that reading extensively and analyzing as many businesses as possible has contributed to his wealth over time. In simpler terms, the key to achieving higher investment returns is to be actively involved. The more stocks you examine, the more shareholder reports you read, and the more educational resources you explore, the better your chances of success. Warren Buffett's example of going through Moody's annual reports in 1951 illustrates the importance of turning pages and immersing oneself in learning. The more effort you put into analyzing stocks and expanding your knowledge of investing, the greater your potential returns can be. So don't hesitate to explore and dive deep into the world of investing, as it can significantly impact your investment success. That's a wrap for today's video, but the excitement doesn't stop here. Get ready for more mind-blowing content coming your way. We'll be pumping out videos 3 to 5 times per week, so buckle up for an exhilarating ride. Drop your comments below with your topic requests because we want to hear from you. And don't forget to smash that like button, subscribe, and hit that notification bell to stay in the loop. Stay tuned for the next thrilling episode on Stock Marketpedia, where we make stocks sizzle.